Session 1. Okay, we're going to do today basic market structure. So this is going to give a foundation on how to view whether you're in a bullish order flow or bearish. And the idea is to not trade against trend. So every trade you take has positive or negative EV. The idea is you want to trade with the trend as opposed to against it. Trading against the trend is going to be negative EV, and you basically have less upside or downside when you're going against the trend. If you're doing it, I'd advise be an experienced scalper before you start doing that. And then if you're relatively new to trading, or less experienced, let's call it, then just trade with the trend. Wait for trend shifts and confirmations. Let me just turn the volume down on my end. It's a little crazy here on a Monday. So let's get into it. So we're looking at the AVAX chart, and the first thing we're looking for is where is the structure, bullish or bearish? And you can see there's a defined zone here. So assuming that this is all the context we have, we basically have range highs, range lows, right? So the idea is you want to see where the initial pivot from the highs came in from, and then where the initial pivot from the lows came from, and you could define that as the true range. So something like this. So this is your true range with some deviations up top and then a deviation below. Your structure comes in at the first pivot over here. So if we go back into the chart, this is your local structure. So basically I'm marking it in with this horizontal ray, and you could see historical structure gets respected in the beginning. So like first interactions with it, typically they will reject. Sometimes they'll reject below and people are like front running that structure, or sometimes they'll raid that liquidity, deviate, and then go back in to the range. But the idea is structure is being confirmed bearish when it rejects and then goes back into the range, and it does it multiple times. So essentially structure becomes stronger the more attempts to break out are failed. Eventually it does break out, and that's where you get your shift in market structure and order flow. But in the beginning, what I want to stress here is that you have initial structure on that first pivot, and eventually when you break above it, you want to see what the behavior is when it returns to structure. If it returns to structure, backtesting it, and then flips it into support, where here it was resistance, here it is support, then you can expect a continuation. If it does something where it breaks above, then comes in, has a weak response, goes back under, and then retest it as resistance, then this was a false bullish breakout, and then you could basically short it back to the mid-range and then the bottom of the range. So the idea is you have initial structure here, you mark it on your chart. You could see with these attempts it's confirming bearish structure, and then on that fourth attempt there's multiple wicks, and then eventually it sends the price down almost 80%. So this is what validates structure. The more attempts to break out that fail, eventually you get a larger expansion down once structure is confirmed bearish, Now you get, oh shit, what happened there? This local structure, you get it all the way up. So I mean, like right here you get your initial rejection, here it backtested, continuation. Here you get a pivot, rejects, and then this wick here, backtested, new all-time high. Eventually what happens is you break below. So here it's holding the previous structure, but it broke below this one, and you could see it fails to make a new high. So the idea is as long as structure remains bullish, every backtest should continue the expansion in the trend. And this is why when I say positive EV, every trade has positive EV, and EV is expected value. So the idea is if things are in a bullish trend, any break above previous structure that rejected, that is backtested and held, assumes that you're going to continue the trend up and then mark the price up again. So you just basically continue trading structure within trend until there is some kind of a shift. Now what is this shift? We'll go back to the original structure here. So a shift is once you've identified the bearish structure, anytime you close above it. So the idea is if it wicks above, it's not a shift. If it barely closes above, it's not a shift. It should always have displacement above the previous structure with candle closures above. Then you confirm a shift. So you can see here it only wicked above. That was a liquidity raid that sent it back down. That wasn't a shift. It didn't close on that time frame. It didn't close a candle above the previous pivot. Here, same thing, slightly different. It closed above, but there was no displacement. You see what I mean? Like here there was zero closure above, so it's a very strong rejection down. Here there's a slight closure above, no displacement, 2 subsequent wicks down, even deeper. Here you get multiple rejections with no displacement, 80% move down. So this right here is confirming bearish structure, and then eventually that leads to a big push down or expansion down within trend, which is bearish. Alright, so here, what's the difference between this closure and this one? You have displacement. That's like the main thing with structure. If you could take anything away from it, any shift above a previous structural level without displacement could be a false move or like a false bullish breakout. Any closure with displacement above previous structure is bullish, and that could be a legitimate structural shift. So right here, it's not confirmed on the breakout. It just gives you like a first signal that there is a shift in order flow, and there is big buying happening here, and shorts from this range over here are getting blown out. So the idea is this is your first step to a shift in market structure. The next thing you normally do once you got a shift, a valid shift in market structure, to confirm it, you're mapping out your dealing range. Hey, no worries, Louis. Happy you're here, bro. We're gonna have a recording anyway. This thing's being recorded, so you didn't miss shit, bro. And so the second step, you're looking at dealing range. So once there is like the first step of a market structure shift where you get displacement above the previous pivot, you're looking at what the dealing range was that formed prior to that. So that's going to be this low to that high, wherever it basically pivots from the high. Now a dealing range is defined as when a low was taken out, so there was a raid of a low, that's going to define the bottom of your dealing range, and a shift or a raid of the high is going to define the dealing range. So if you zoom in and we highlight the dealing range, you can see that this wick took out that low, so that's going to define the bottom of the dealing range. So then if we go up to where the shift happened above the previous structure, this high took out that high, so that's going to define the top of the dealing range. Now if that high stopped over here, this is not a true dealing range because the high didn't take out the previous high, so that can't be considered a dealing range yet. But once you have a pivot that closed above this high or even wicked above, now you have a raid of the low defining the bottom of the dealing range, and a raid or shift above the previous high, top of the dealing range. So where you confirm the shift in market structure is once your dealing range is on the chart, you look at, this is premium, this is discount, this is equilibrium or fair value. You're looking for a retracement into discount below equilibrium, and then you're looking for a bid to come in around there at previous structure. And if it basically holds that level in discount, then it's flipping bearish structure into bullish structure here. And then what this is called is a structural back test. So this is where you confirm a shift in order flow or a shift in market structure. And then if you really wanted to, another way to look at the zone is a reactive zone. So let's say I don't use horizontal rays, right? You could look at it this way too. the thing is it's messy and it's like very arbitrary where you define the zone, right? So when you're plotting it on your chart, some guys will plot it from this wick to this wick. Some guys will plot it from the extreme high to this wick, the extreme high of the top wick here. So it's very arbitrary. What I normally do if I'm trying to define a reactive zone or a reactive structural zone is when it's messy like that, go into this. So click that tab and go into line chart and use the candle closures. So in the bar chart you get not only the candle bodies, but you get the wicks as well. The wicks make it messy, right? So what I'll normally do is look for candle closures. Where did the candles close, defining the structure before it broke above? And then what I use is the original pivot here to this high. You could even go up to that high. I would say that is valid too. And then go back into candles, and what you're looking for is within your dealing range when it pulls back into equilibrium to backtest that reactive zone. And this would be like a successful backtest confirming a shift in order flow. So then from here, if it does confirm, now you can expect them to take out the previous high and then expand up and create a new trend with bullish order flow. So with that, you now start getting these shifts in bullish market structure, where basically this was the first resistance or pivot. You get a structural backtest here, and then you start expanding above it. You get another pivot here, and you can see what it's doing. It's basically taking previous market structure or this reactive zone, and it's bouncing off that, using it to expand. Motherfuckers doing crime on a Monday, brah. What is this? Alright, so that's hilarious, man. You're getting booked. Too much sauce, bro. Lock that man up. Too many Hitler videos. We can't have this. Oy vey. Server getting shut down, bro. Mossad attack. Alright, so like I was saying, once you break above previous bear structure, you start looking for the back test of it. And then if it holds, you're expecting previous pivots to get violated until they don't, right? So you can see what it's doing. Back testing previous structure, continuation above the pivot, all-time high. This is where you start getting a shift in order flow again. So basically it makes an all-time high, it comes down to this level here, and then it pivots up, but it fails to make a higher high. So what you have is a scenario where you have one high, a low, then a lower high. So within market structure dynamics, if you make a lower high, you're waiting to see if this previous pivot here gets violated and makes a lower low. If it does, then it is your first indication that order flow could be shifting on whatever time frame. We're using the daily for the example just to keep it clean, but this it's fractal, so you could see it on the 5-minute time frame, you could see it on the monthly depending on how old the asset is, but on every time frame what you're looking for is high, low, lower high, lower low, and then sorry, one sec, I gotta mute. Okay, we're good. So high, low, lower high, lower low, and then with that lower low we're confirming a bearish shift in order flow. Sorry, one sec, someone's got a hot mic. One sec. Alright, we're good. Oh, maybe not, sorry. Ishan, hold on. Sorry, Cheddar, I thought it was your mic. One sec, bro. I'll start doing, you know what I might do? I might put this in the live stream section. That way people's mics are off, because I get thrown off easy, bro. I'm like an autodidact retard. Little things will throw me off, you know? I hear someone heavy breathing, my mind just starts going into weird places, you know what I mean? and then I just can't focus on the charts. I'm retarded. Easy to throw me off. Mouth breathing. Bro, a lot of mouth breathers on the server. A lot of high IQ. I told you, man, like, we're high IQ retards, bro. It's like the best, perfect blend, you know? We're just retarded enough to be decent traders, but we're also high IQ enough to pick this shit up, you know what I mean? And have fun. Alright. So anyway, high, low, lower high, lower low. So when this high is already kind of raising eyebrows, we're like, oh, okay, this is kind of looking weird. They failed to make a new high like it did here, right? So it made basically high, low, higher, low. That assumes once you've successfully backtested previous structure that you're going to expand up again. Here you made high, low, lower high, lower low. That automatically should indicate to you that this is shifting order flow and that you're probably going into a sell program. So if I clean this up, this is what we're looking for to confirm a shift in order flow and bearish structure to start getting respected. So it's confirmed here, like this lower low is confirming a bearish shift that happened over here. And then what we're doing again is we're just mapping out our dealing range to confirm everything, right? So let me pull up dealing range, and it's the same thing we did down here. We're outlining the swing low that took out a previous low and swing high that took out a previous high. So basically this was the previous structural high. That high took that one out. So that's our dealing range high. This was our previous swing low that led to the lower high. So this low took out that previous low. So that's our dealing range low. So essentially our current local dealing range for a short is basically between dealing range high to low. This is our fair value. This is premium. If we're short bias now and short has the higher EV, we're looking for retracement back into premium, into a level, whatever level you define. But the idea is when it gets into premium, you want to see rejection and then continue bearish order flow, breaking previous structure right here. So you could see how it shifts here perfectly. This is your bearish shift. This is where it confirms. Your dealing range maps out, you reject in premium, and then instantly start making its way below this level right here. And then you can see what it does on initial contact. It'll look at previous structure that we outlined here and use it as support, but this is just like a pit stop before going lower. You know what I mean? So like once you understand that order flow shifted up here, a positive EV is in taking short only. So you switch into a short only regime. And the idea, like I said in the beginning of the stream, you want to trade, especially as a newer trader or like a less experienced leverage trader, you want to trade with the order flow, and it's always going to have higher expected value than counter trading. Like if you shift over here, any pullback you're shorting for a scalp. But if you're a newer trader, forget it. Don't even attempt to short. Just wait for the pullback into previous structure and look for only longs. See what I mean? So over here, same thing. You have a dealing range high to low. There's a pullback into premium. You can see they form like a short-term high here, and then they basically take out that high in premium and then send it down again. And this previous structure, if the order flow has shifted, this is only a scalp. This is for more advanced traders that are going to scalp within a short only regime. So up here, this is going to be all like you're looking for longs. On this side of the sell side of the curve, you're only looking for shorts. And if you're a good scalper, you can take a scalp long here into whatever level. But the idea is if you're newer, just focus on the short once you have a bearish shift. So then here you can see that level, they try to hold it again, and then eventually it breaks down, hunts these lows, and then even lower it goes down to take out the external low eventually, and then you shift into bullish order flow. And this repeats, like basically any asset that you trade, it doesn't matter if it's AVAX, Mudang, gold, crude oil futures, whatever it is, they all respect basic market structure and order flow. So the last two items here we'll go over, like now that we know what basic market structure is, reactive zones, dealing range, shift in order flow, here and here, and the concept of positive and negative EV depending on the order flow. We'll go over one last thing. It is so this is just an expansion over the original structure here. So when this got broken, they back tested and then continued up. On the backside, like once you've shifted to bearish order flow here, what the market will typically do is they'll look at previous pivots and back test them as resistance. So that's called an inversion. They're inverting a level. So basically, previous resistance, let's say right here, this was previous resistance. Over here it used it as support when it back tested it, and then it went up. Same thing here, it used it as support and then it made a lower high. Here it tried and then it made another lower high. So what ends up happening on the back end, once order flow shifted, they'll use previous pivots as resistance. So that was your last point of resistance here before a larger expansion down. And then you could see it here too. So this was resistance, back tested here, all-time high. On the backside, once bearish order flow kicked in here and you started to get bearish market structure, they used that as resistance again. 1, 2, 3, bigger expansion down. So even here, you could see inversions happen locally. Right here, the original, like if we go again, it's messy on wicks, but like here you could see the pivot on the candle close. It was attempting to make higher highs and then basically continue the move up. But too many touches of that. So one of the other, like, I guess advanced market structure concepts would be the more test of a structural level, the more porous it becomes on the sell side of the curve. So if they keep testing this level, eventually it breaks down. And then what you get is an inversion between here and here. You can see it back tested as bearish structure and then continues down. Same thing on the sell side. The more attempts to break out, eventually it breaks down. But once it breaks above, that level holds as support. So the idea is these structural levels, they become porous after a certain amount of touches, right? And then eventually when they do break down or break up, they become inversion levels. So this right here became an inversion that was supporting prices lower until they took out the external low right there. Eventually, right there. So the last thing, again, this is the first session. I don't want to like kill you guys with too many ideas. Like, this is more than enough to trade daily. You honestly don't need that much more. Once you learn like liquidity concepts on top of this, I mean, you're gold. You probably have like 80 to 90% of what you need. But just being able to identify order flow, and when you're trading on side with the order flow and when you're offside, that's like half the game. You know what I mean? Like, to be longing once bearish structure has shifted, it's kind of retarded, right? You shouldn't be doing that unless you're like advanced scalper. But the last thing right here for today. Alright, so this original bearish structure that was created here, that we back tested here, you might be asking, okay, that's a wide zone. Well, how am I going to trade a zone that's like, let me pull it up. So from top to bottom, it's like 12%. Like, that's a pretty wide zone to trade. One thing I do when I'm trying to really isolate where the volume is and like where the sweet spot is within structure is I'll map out the previous range volume profile. So here's the example we're going to use. Actually, take that one off. So again, this was the 12% range for that reactive zone. But what I do is map out from the beginning of the range to where the origin of the breakdown happened here. And I'm looking at the fixed volume profile. Where is the largest cluster of volume traded within that reactive zone? And you can see there's a bit of a spike on the histogram right here. That's your high volume node. So this is within this structure, this is the node that has the most volume, and when you close above it, that volume node is supposed to be the most support on the backtest. So you can see if you entered up here at the top, your risk would be, let's say the top of the reactive zone to the low, 18% move down from there. You're like almost certainly going to get stopped out on that, right? But if you identify where the volume is clustered, now your risk, or like where you really aggressively start hunting, shifts from that level to here only 11%. So again, it's just a way of identifying the sweet spot within a previous node in order to structure a trade around this right here. And then you would essentially drop from a daily into a 1 hour looking for structure, and then 5 minute to take your entry model. So the idea is you're using this on the high time frame just to identify the sweet spot within that level or reactive zone, and then you're flipping it from the daily into the 5 minute time frame to look for an entry model. And then let's see, I'll actually drop it. I never looked at this on the 5 minute. Let's see in real time if there was a setup in here. Yeah, here it is, perfect. Okay, actually we start with the 1 hour, and I'll show you guys how the entry model would have looked like. Okay, so that 1 hour candle, this is an order block. And then you get a pivot high, pivot low. So basically this is your dealing range. You're looking in discount somewhere here on the high volume node. So right here you can see another order block come in, and then it's holding the volume node. So somewhere here you're looking for a 5 minute entry. Alright, so here it is. You have a raid, and if you look in the top left corner, this is like a blueprint for new traders. Take a screenshot of that and then anchor it to your chart. What's up, Banty, bro? So you can see when I move, that is like static on my chart. It doesn't move. That way, no matter where we are trading, I'm referencing that. So like this is something I used when I was relatively new. So I want you guys to basically take a screenshot of that, and then what you do is click on it, click this lock, because if I unlock it, it does that, right? But if I click lock, now it is static and it goes wherever the price action goes. So you're always looking at it, you're like forced to know, these are my rules. I want to see these things happen. And the idea is you're entering with this liquidity raid, shift with displacement, enter in the imbalance or order block above 50% of the dealing range, and it should have a solid risk reward. So the first part of that, let me move it just for the example. Okay. Oh shit, why is it? Alright, hold on. There we go. So here's your raid. So that's the first part, right? Liquidity raid on the entry model. Here's your shift. So this is the high of the origin of the move down that raided this low. So you want to see a candle close above that. That's going to be your shift for the entry model. So you have a raid, shift with displacement, okay? Enter in the imbalance or order block above or below, in this case below 50% of the dealing range. So basically this low took out that low, that's your swing low for the dealing range. This high took out that high, that's the swing high of the dealing range. This is equilibrium, 50%. So below 50% of the dealing range, you have this liquidity, these equal lows got taken out here into this imbalance. So this would be your entry. And this is like a textbook low time frame entry. Like this is absolute sauce. If you just learn this entry model and how to time frame align, honestly this is all you need. Like we could close this whole thing on session 1 and you guys would be good at this point. But yeah, so like this is it. Raid, shift, dealing range. These lows get taken out into this imbalance and then it holds. Your entry is going to be there once it holds. Where is it? Okay, somewhere here maybe. Stop below that previous low. Now you have 5% risk, right? But your target is going to be previous highs or liquidity. So here you have equal highs. Your first target would be into structure, previous structure of these equal highs. I'm not saying this trade is going to work out, but hold on. Dude, my trading view is acting weird. Hold on. Alright, there we're good. There it is, boom. So like a quick intraday trade that eventually expands way higher, but this all started off market structure. So the idea was on the daily, if we go back, we identified the reactive zone, right? Where it kept getting rejected. Then we identified, let me get out of replay so you can see the volume. There it is. Then we identified the volume within the dealing range, or sorry, the volume within this range. We identified the high volume node. So then we use that as the sweet spot to key off our low time frame entry. And then what happened, we went from daily into the 1 hour just to see where the order block was, where there was starting to show some support. Oh damn, I had to basically go into replay and cut some of the chart. But anyway, we went into the 1 hour. So we went from daily to 1 hour. That's time frame aligning. We look for structure, that 1 hour order block to kick in. And then we dropped it to the 5-minute time frame using this concept for the entry model. And then even a scalp into this high, these equal highs, that was like the scalp part of the trade. But look how much farther the trade went. It went to all-time high just from identifying the first market structure shift. So that ended up being a 322% move, 65 risk reward, meaning if you put $100 on, you would get back $6,500 on that trade, just because you knew like basic market structure in the range. So like this is a real application of how to use market structure. So now we have basically theory, and then we have like a way to apply it to the chart to actually make a trade. So that's it for the session. I'm going to cut it here.